Hello, everyone. Welcome to the first episode of Trading 101 presented to you by Farm Student Association. So in this episode, we'll be taking a look at stock chart technical analysis. So I'm Madeline Pollock. I'm a market research analyst on the market research team this term. And so just before we begin, here's a bit of an overview of what we'll be discussing. So I'll give a brief introduction to technical analysis and to why it's so useful, and then we'll go through some examples more focused on chart analysis. So what is technical analysis? So technical analysis is a trading discipline that helps traders to identify trading and investment opportunities. Technical analysis leverages historical data to help identify patterns and trends in the markets. So there's two kind of main branches of technical analysis. There's using technical indicators, which is more looking at statistical methods and looking at different indicators such as moving averages. And then there's chart analysis, which we'll focus on later in this video, which is more subjective, involves actually looking at different charts that are using technical analysis and trying to identify patterns are used predominantly in the market. So why do we use technical analysis? So technical analysis does focus on historic prices and volume to predict future events. So it alleviates any concerns or requirements to look into the fundamentals of a business and its earnings to calculate price, or to use that to predict where the price is going to go. We really do focus on the trends that we do see in the historical data, and that we believe that can tell us where the price movements will go, especially because that gives us an indication of where the supply and demand is for the stock and how it responds to movements in the market. So it's useful in that regard to identify future movements and find those investment opportunities. So there are some assumptions that come with technical analysis that you should be aware of. So first is that the market discounts everything. So this indicates that we really do take into account any psychological behavioral factors that could influence the market and its trading, as well as the fundamentals of the business, which we talked about a bit already. So really it's assumed that those factors are already put into the price. That's something you have to calculate. The price really should be reflecting everything, as well as supply and demand. So technical analysis is very widely used, and with that brings the assumption that the price reflects the supply and demand efficiently, as everyone's kind of following the same methodology. So it really is congruent with the efficient markets theory from economics. The second is that the price moves in trends. So we're more likely to see the price continuing to follow a trend than seeing different erratic movements, regardless of what's going on in the market. And the third is that history tends to repeat itself. So we do have a lot of identified patterns or trends that we follow to predict where the market can go. For example, a bearish engulfing pattern, which we'll get into later. And based off previous performance of those patterns and their outcomes, we expect similar patterns that we're seeing now to follow the same results. And the last key note to make about technical analysis is that we assume that the market has processed all available information, and that's reflected in the price. So whether that be different economic factors or global events that could have an impact on the market, or things specific maybe to the company for the stock or the commodity or the currency that you're looking at, that's already assumed to be factored into the price, because we really are seeing that supply and demand aspect. So different traders would have already taken that into account, and we should be seeing that reflected in the price. So as mentioned previously, one of the main sectors of technical analysis is chart analysis. And so chart analysts trying to identify areas of resistance or support by actually looking at a visual chart. So this could be, for example, a line chart, a bar chart, or a candlestick chart, which is one of the most commonly used. And that's what we'll take a further look at. And these patterns are used to predict where prices will head. So there's already pre-outlined patterns that we've already anticipated what this could mean and represent. So analysts will try and look for these identified patterns and leverage those to predict where they see the market going or what it could really mean. So the candlestick chart is one of the main charts that's used in technical analysis, especially for stocks. So candlestick charts visually represent the size of the price movements within a certain period of time. That period of time being represented with these candlesticks. And they don't just show, one type of price, like the bid price or the ask price that you may be able to see with just a line chart, but they do show 4 different price points: the opening, the closing, the high, and the low. So for a bearish candlestick, we'll see that the opening is higher than the closing, indicating that the price was decreasing, versus seeing a bullish candlestick where the close is higher than the open because it was increasing. So this is the opening and closing are bounding by the actual candle part itself. But then we also have what are called the shadows. So there's the upper shadow and the lower shadow, which indicate how far the price really moved within that period, to the high and to the low. So let's take a look at an actual example of a candlestick chart. So here we have a candlestick chart for Amazon. And so here we can already look for and identify some different patterns that we may see. So for example, here we have what is called a bearish engulfing pattern, as well as here we also see another bearish engulfing pattern. So how do we identify this? So really, after an up movement that we're seeing, we see then a candlestick, a bullish candlestick that's a lot shorter, being then followed by a much larger bearish candlestick. And this is to indicate that after a big up movement or any up movement, that the price is now going to change direction. And we can kind of use that to say, okay, maybe now is a good opportunity to short the stock or to sell any long positions that we may have. And this is a lot more useful and a lot more significant after a significant up movement. And it kind of does indicate that change of direction for the worse. But then here we also see kind of a bit more of a stagnation going on. Stock price doesn't seem to be that volatile here. And what we have, or what we see a lot of, is these called spitting tops. So when we see bearish and bullish dojis consecutively, so we don't really know where the direction is going to move. It's kind of going back and forth between the two. And a doji is a candlestick that almost looks like a cross or plus sign. So its body or the candle part is very short. So we're seeing a lot of alternating bullish and bearish dojis, and that's why we're kind of not really seeing a change in the price in this area. Okay, so let's take a look at some other chart examples that are commonly used in technical analysis. So first, we have the bar chart. So similar to the candlestick chart, we do also have those 4 different price points. So if we look at a particular bar, we can see that we have the opening and the closing price, as well as the high and the low within each bar. Then we also have the line chart, which gives a lot less information, but it's a lot easier to follow. So here we're just seeing the closing price, but it's a lot, I think, simpler to visualize these trends without other factors and external noise. And then we have the area chart, which also makes it a lot more easy to kind of see these trends in the price. And then we have an open candlestick chart, so similar to the candlestick chart, but typically within a bullish period, we'll have an open candlestick. So remember, that's when the closing price is higher than the opening price. And then for bearish, we'll typically have a solid candlestick. So thank you so much for watching. Please remember to subscribe and hit the notification bell so that way you can be updated and notified whenever we post a new video or new content. Thank you so much for watching.